Welcome back to XRP Intel Authority, the channel that cuts through the noise and gives you the real story behind every move XRP makes. Today we are diving into something big. The truth about XRP finally came out. And trust me, by the end of this video you are going to understand exactly why some of us have been saying $100 or even $1,000 XRP is not some crazy internet fantasy. It comes down to two massive catalysts, and once you see them laid out, the whole picture starts making sense. Whether you just clicked on this channel for the first time or you have been riding with us for years studying this asset closely, this breakdown is for you. We have watched XRP closely for almost a decade now, and one thing has become crystal clear over and over again. When real catalysts line up for this coin, the results are not small. The last time something like this played out, XRP went on a run of about 60,000%, climbing from half a penny all the way up to $3.80. Nobody is promising that exact number again, but the structure behind that move is starting to rhyme with what we are seeing today, and that is worth paying close attention to. Now let's talk timelines for a second, because this is where a lot of people get frustrated, and honestly, we get it. The wait has been longer than many of us expected, and that delay has tested patience across the entire community. But stretching out does not mean the path disappeared. It just means the finish line moved a little further down the road, not off the map entirely. There is still a light at the end of this tunnel, and what we want to show you today are the two specific catalysts we are personally watching that could push XRP toward those much higher price levels everyone keeps talking about. We are not here to throw out wild numbers just to get clicks. We are here to walk you through the actual mechanics, the actual regulatory pieces, and the actual supply dynamics that could make this happen. So stick around, because this is one of those updates that ties a lot of loose ends together, and it might change how you are looking at your XRP position going into the second half of this year. Let's start with the bigger market picture, because context always matters. Bitcoin cooled off slightly overnight, dipping back toward the $65,000 mark, but it bounced right back above 66,000 and even touched 67,000 the day before. That recovery lines up with some major geopolitical news, with reports that the Iran conflict and the related airstrikes are being called off, with a peace deal reportedly getting signed sometime this week. Markets love certainty, and the moment that kind of news drops, you can see risk assets like crypto respond almost instantly. Perception really is reality in these markets. The moment fear comes off the table, buyers come right back in, and we saw that ripple straight through to XRP, which pushed up to around $1.29 on the back of that broader relief rally. It is a good reminder that XRP does not move in a vacuum. Global headlines, war fears, and macro sentiment all play a role in short-term price swings, even while the long-term story is being written by completely different forces underneath the surface. On a personal trading note, Hyperliquid has been one of the more exciting plays recently. We took profit on a trade there for about 56%, selling off around the $63 level, and almost immediately watched it pull back exactly into that $50 to $55 zone we were hoping to scoop back up at. That is the tricky part of trading active positions while also building a long-term stack, because by the time that pullback hit, most of the available capital had already been allocated into other plays, including adding more XRP and picking up additional HBAR over the past week or so. The plan moving forward is to keep doing exactly that, using profits from shorter-term trades to continue stacking the assets we believe in for the long haul. If you are exploring ways to hold digital assets in a more tax-efficient structure, that is where a sponsor like iTrust Capital comes into play, offering tax-advantaged crypto IRA accounts, premium custody options, and treasury accounts built for businesses, trusts, and LLCs, with stocks and ETFs reportedly on the way and precious metals already available through institutional-grade custody. Now here is something that flew under the radar for a lot of people but deserves real attention. The XRP ledger just rolled out version 3.2, and one of the more interesting changes is a renaming of the underlying software. It is no longer being called Rippled. It is now officially being referred to as XRPLD. Old amendments are being retired, bugs are getting cleaned up, and the whole ecosystem is getting a fresh coat of paint under the hood. This might sound like a small cosmetic update, but symbolically, it matters a lot. For years, the community has had to fight off confusion between Ripple the company and XRP the ledger, with critics constantly trying to blur the line between the two. This rename helps draw a clearer distinction. The software running this network is open source, decentralized, and permissionless, just like Bitcoin, but built specifically to handle real factual utility at scale, and increasingly capable of carrying more liquidity onto its rails than people might expect. Sentiment data is also telling an interesting story right now. According to tracking from Santiment, community sentiment around XRP has dropped to its lowest point of the entire year so far in 2026. On the surface, that sounds discouraging, but if you have been paying attention to market cycles for any length of time, you know that extreme fear inside a community often lines up with major turning points. Historically, when sentiment bottoms out like this, it tends to set up relief rallies, and sometimes those relief rallies turn into much bigger moves. The best entry points are usually found exactly when nobody wants to talk about the asset anymore. When even the most loyal holders start sounding tired, that is precisely why staying grounded in fundamentals matters so much right now. This is not about hyping new buyers with talk of five-figure XRP. It is about understanding the actual structural changes happening underneath the price chart that could eventually justify those bigger numbers down the road. Let's talk tokenization, because this is the real engine behind future demand. Bringing tens or even hundreds of trillions of dollars worth of real-world assets onto a blockchain requires infrastructure that can actually handle it, and the XRP ledger is showing serious growth in this category. RLUSD in particular has been leading the charge, climbing roughly 224% so far this year, moving from around $235 million up to about $762 million in value as of data pulled on June 10th. A common misconception floating around is that stablecoins like RLUSD are somehow replacing the need for XRP itself. That is simply not how the system works. Every single transaction on the XRP ledger requires a small amount of XRP to be locked up and used as a transaction fee, and that fee gets burned. It is technically impossible to interact with the ledger without touching XRP in some form, even if the amount burned per transaction is tiny. As more real-world assets get tokenized and added to the chain, the underlying demand for XRP as the connective tissue of the network only grows stronger. This brings us to one of the most overlooked features on the entire ledger, which is auto-bridging. Picture someone wanting to swap Tether for USDC directly on the network. In many cases, the deepest liquidity and the fastest execution path is not actually a direct swap at all. Instead, the system might route that trade through XRP first, going from Tether to XRP and then from XRP to USDC, because that pathway offers better liquidity than a direct pairing would. XRP effectively becomes the bridge currency sitting in the middle of transactions between completely unrelated assets. This single feature destroys the narrative that stablecoins or tokenized assets are going to make XRP irrelevant. It is structurally the opposite. The more real-world assets and stablecoins that get added to the ledger, the more reasons there are for XRP to be used as the connecting piece that makes efficient swaps possible across the entire network. Shifting over to the institutional side, BlackRock just launched its Bitcoin Premium Income ETF under the ticker IBIT-related naming, targeting an annual yield somewhere between 15 and 25%. That is a serious number, and it reflects just how aggressive major asset managers are getting with structured crypto income products. What makes this interesting from an XRP perspective is what it might be setting up behind the scenes. BlackRock already has its spot Bitcoin product live, and now a premium income version on top of that, but there is still no XRP ETF from BlackRock yet. Many believe that gap is intentional, almost like clearing the runway before eventually rolling one out. If and when that happens, expect to see a similar layered approach, starting with a spot product and potentially followed by income-generating versions down the line. The bigger takeaway here is that XRP holders are going to end up with a wide spectrum of yield options eventually, ranging from massive traditional institutions like BlackRock all the way down to decentralized finance protocols with plenty of middle ground in between. Here is where we get into the real meat of this video, the two catalysts that actually matter most. ETFs have been somewhat disappointing in terms of price impact so far, mostly because flows have been happening over the counter rather than through open market mechanics that would typically apply a market cap multiplier effect. That has kept a lid on price action despite genuine institutional interest. But the catalyst we are watching most closely right now is not another ETF announcement. It is the Clarity Act, specifically a provision believed to fall under Section 205, which states that for a blockchain to be classified as mature and therefore not treated as a security, no single entity, person, or company can hold more than 20% of total supply. That single rule, if it passes as written, could be the most important sentence in the entire piece of legislation as far as XRP is concerned, because it directly forces a known holder to make moves. If that 20% rule becomes law, Ripple would need to bring its own holdings below that threshold. That is catalyst number 1, and it sets the stage for catalyst number 2, which is Ripple formally announcing that it has effectively completed the distribution of its XRP holdings to banks and institutional partners around the world. Once that distribution wraps up and Ripple's holdings drop below the 20% mark, the expectation is that the company would significantly reduce and possibly almost completely stop its routine programmatic selling of XRP on the open market. There may still be small amounts sold here and there to fund specific liquidity corridors, but the bulk of regular selling pressure that has weighed on price for years could finally come to an end. That shift represents a genuine supply shock setup, the kind of structural change that historically has preceded major price expansions for this asset. To understand why this matters so much, it helps to look back at 2017, because the parallels are striking. Back on May 16th of that year, Ripple announced it would lock up 55 billion XRP, roughly 55% of total supply at the time, into escrow, committing to complete that process by the end of 2017. On December 8th, Ripple confirmed the lockup was finished, with the actual on-ledger escrow contracts finalized around mid-December. Looking at the price chart from that period tells an incredible story. XRP had already been climbing from half a penny toward the start of 2017, breaking above a penny and eventually spiking up to around 6 or 7 cents before the escrow announcement even landed. The day after the announcement hit, XRP spiked to roughly 40 cents in a classic buy the rumor, sell the news pattern, then promptly dropped back down to around 13 cents, where it spent most of the year chopping sideways and testing that level repeatedly. It was not until the escrow was actually completed in December, right in the middle of the broader 2017 bull market rotation out of Bitcoin and Ethereum, that XRP truly exploded, eventually rocketing all the way up to $3.80. From that bear market low to the eventual peak, you are talking about a move in the neighborhood of 60,000%. Numbers that genuinely look like a meme coin chart rather than a top 10 cryptocurrency. The lesson buried in that history is that the initial announcement created a short-term pump, followed by a long, frustrating consolidation period where plenty of people gave up and sold near the bottom, only to watch the real move happen months later once the process was officially finalized. That same pattern, announcement followed by consolidation, followed by completion, followed by explosion, is exactly the structure we are watching for again with the Clarity Act and Ripple's eventual distribution completion announcement. Looking at where XRP sits today, trading above $1, it is not unreasonable to imagine a launchpad forming somewhere between $1.50 and $3 over the coming year, as these pieces play out, assuming the Clarity Act gets signed, ideally before the August recess, though delays are always possible given how legislation typically moves. Even if it gets pushed out further, the broader direction still points toward eventual passage in some form. If and when that 20% provision becomes binding, expect intense market attention to shift directly onto Ripple, with speculation swirling around how the company plans to handle its remaining holdings. Many believe Ripple has already quietly prepared for this exact scenario for years, given its consistent presence in Washington and its involvement in shaping regulatory conversations long before most people were paying attention to this specific provision. The final piece of this puzzle is recognizing that Ripple likely does not want to drop its holdings all the way to zero. The realistic expectation is that the company maintains a meaningful reserve, whether that lands closer to 10 billion or 20 billion XRP, while still working toward the larger goal of ending routine programmatic selling altogether. The combination of the Clarity Act's 20% rule forcing an initial reduction, followed later by a formal announcement that distribution is complete and selling has stopped, mirrors the two-stage pattern from 2017 almost perfectly. Nobody can say for certain this happens within the next 12 months, and we are not putting a hard date on any of this, but these are genuinely the two catalysts worth watching closely. If they play out the way history suggests they might, the resulting supply shock could finally give the market the clarity it has been waiting years for. And that kind of clarity has a way of pulling even the most skeptical holders back into buying mode almost overnight. So that is the real story behind these two catalysts and why so many long-term XRP holders continue believing in those bigger price targets people often dismiss as impossible. We are not telling you to expect overnight riches, and we are not putting a date on any of this, but understanding the mechanics behind the Clarity Act, Ripple's holdings, and the historical precedent from 2017 gives you a much clearer lens to view this asset through heading into the rest of this year. Drop a comment below and let us know what you think about these two catalysts, and whether you believe this is the setup that finally gets XRP moving toward those long-awaited higher price levels. If you found this breakdown valuable, smash that thumbs up button, share this video with someone still on the fence about XRP, and make sure you are subscribed so you never miss an update. This has been XRP Intel Authority, bringing you the truth behind the headlines, and we will see you in the next one. Share.